Welcome to our exploration of market trends and their profound impact on investments. In today's fast-paced financial world, understanding how trends develop and influence markets is crucial for anyone looking to make informed investment decisions. Whether you're a seasoned investor or just starting out, recognizing the patterns and shifts in the market can help you anticipate changes and adapt your strategies accordingly. Throughout this video, we'll break down what market trends are, why they matter, and how they can affect your investment portfolio. Let's begin by defining what we mean by market trends and why they are so important. Market trends refer to the general direction in which a market is moving over a specific period. These trends can be upward, downward, or sideways, and they are shaped by a variety of factors such as economic indicators, investor sentiment, and global events. By identifying these trends early, investors can position themselves to take advantage of potential opportunities or avoid possible pitfalls. Understanding the nature of market trends is the first step in building a resilient investment strategy that can weather different market conditions. There are three main types of market trends: upward bullish, downward bearish, and sideways neutral. An upward trend is characterized by rising prices, while a downward trend features falling prices. Sideways trends occur when prices move within a narrow range, showing no clear direction. Recognizing which trend is currently dominating the market can help investors decide when to buy, hold, or sell their assets. Each trend presents unique challenges and opportunities, making it essential to stay informed and flexible. Spotting market trends early can give investors a significant advantage. By analyzing historical data, monitoring news, and using technical indicators, investors can detect emerging patterns before they become obvious to the broader market. Early identification allows for timely entry or exit, maximizing potential gains and minimizing losses. It's not just about watching numbers, it's about understanding the underlying forces driving those numbers. This proactive approach is a hallmark of successful investing. Economic indicators such as GDP growth, unemployment rates, and inflation are key drivers of market trends. These indicators provide insights into the overall health of the economy and can signal potential changes in market direction. For example, rising inflation might lead to higher interest rates, which can impact stock and bond markets differently. By keeping an eye on these indicators, investors can better anticipate shifts and adjust their portfolios accordingly. Investor sentiment reflects the overall mood of the market participants. When investors are optimistic, markets tend to rise, while pessimism can lead to declines. Sentiment can be influenced by news, rumors, and even social media trends. Understanding the psychological aspect of investing is just as important as analyzing numbers. By gauging sentiment, investors can sometimes predict short-term market movements and adjust their strategies to align with the prevailing mood. Global events such as political elections, natural disasters, or international conflicts can have an immediate and sometimes dramatic impact on market trends. These events often create uncertainty, leading to increased volatility as investors react to new information. Staying informed about global developments is essential for making timely investment decisions. By understanding how world events influence markets, investors can better manage risk and seize opportunities as they arrive. Not all trends are created equal. Some last only a few days or weeks, while others can persist for months or even years. Short-term trends are often driven by news or events, while long-term trends reflect deeper economic shifts. Understanding the difference helps investors choose the right strategies for their goals. For example, day traders might focus on short-term trends, while long-term investors look for broader patterns that indicate sustained growth or decline. Technical analysis involves studying charts and patterns to predict future market movements. By examining price history, volume, and other indicators, investors can identify trends and make informed decisions. Tools like moving averages, support and resistance levels, and momentum indicators are commonly used in technical analysis. While not foolproof, this approach can provide valuable insights, especially when combined with other forms of analysis. Fundamental analysis focuses on evaluating a company's financial health, industry position, and growth prospects. By analyzing financial statements, earnings reports, and market conditions, investors can determine whether a stock is undervalued or overvalued. This approach helps investors make long-term decisions based on the intrinsic value of an asset, rather than short-term market fluctuation. Technology has revolutionized the way investors track and respond to market trends. With real-time data, advanced analytics, and algorithmic trading, investors can react faster than ever before. Mobile apps and online platforms provide instant access to market information, enabling more informed and timely decisions. Embracing technology is now a key part of staying competitive in the investment world. Markets move in cycles, typically alternating between periods of growth and decline. Recognizing where we are in the cycle can help investors make better decisions. For instance, during a bull market, optimism prevails and prices rise, while a bear market is marked by pessimism and falling prices. Understanding these cycles allows investors to adjust their strategies and expectations accordingly. Different sectors of the market can experience trends independently of the overall market. For example, technology stocks might be rising while energy stocks are falling. By analyzing sector trends, investors can diversify their portfolios and reduce risk. It's important to understand which sectors are leading or lagging and adjust investments to capitalize on these shifts. Globalization has interconnected markets like never before. Events in one part of the world can quickly influence markets elsewhere. Investors must consider global trends such as international trade agreements or currency fluctuations when making decisions. Staying aware of these global connections helps investors anticipate changes and manage risk more effectively. Understanding market trends is essential for effective risk management. By recognizing when markets are likely to become volatile, investors can take steps to protect their portfolios. This might include diversifying assets, using stop-loss orders, or shifting to safer investments during uncertain times. Proactive risk management helps preserve capital and ensures long-term growth. Behavioral finance studies how psychological factors influence investor decisions and market trends. Emotions like fear and greed can drive markets in unexpected directions. By being aware of these biases, investors can make more rational decisions and avoid common pitfalls. Understanding the human side of investing is just as important as analyzing numbers and charts. Market trends have a direct impact on stock prices. During an upward trend, most stocks tend to rise while a downward trend can drag prices lower. However, not all stocks move in the same direction or at the same pace. By analyzing trends, investors can identify which stocks are likely to outperform or underperform, helping them make more strategic investment choices. Bonds are also affected by market trends, especially those related to interest rates and inflation. When interest rates rise, bond prices typically fall and vice versa. Understanding these relationships helps investors balance their portfolios and manage risk. Keeping an eye on economic indicators and central bank policies is crucial for bond investors. Real estate markets are influenced by broader economic trends such as employment rates, interest rates, and consumer confidence. When the economy is strong, real estate values tend to rise, while downturns can lead to falling prices. Investors in real estate must stay informed about these trends to make sound decisions and maximize returns. Commodities like oil, gold, and agricultural products are highly sensitive to market trends and global events. Supply and demand, geopolitical tensions, and currency fluctuations all play a role in determining prices. Investors in commodities must be especially vigilant, as these markets can be volatile and react quickly to new information. Diversification is a key strategy for managing the impact of market trends. By spreading investments across different asset classes, sectors, and regions, investors can reduce risk and improve returns. Diversification helps ensure that a downturn in one area doesn't derail your entire portfolio. It's a fundamental principle for long-term investment success. Trying to time the market, buying low and selling high, can be tempting, but it's notoriously difficult. Even experienced investors struggle to predict short-term movements. Instead, focusing on long-term trends and maintaining a disciplined approach often yields better results. Patience and consistency are key to successful investing. News plays a significant role in shaping market trends. Major announcements, earnings reports, and geopolitical developments can all trigger market movements. Staying informed and critically evaluating news sources helps investors separate noise from meaningful information, leading to better decision-making. Market corrections are short-term declines that occur after a period of growth. They are a normal part of market cycles and can present buying opportunities for savvy investors. Understanding the difference between a correction and a long-term trend reversal is crucial for making informed decisions during volatile times. Market bubbles occur when asset prices rise far above their intrinsic value, often fueled by speculation and exuberance. Eventually, bubbles burst, leading to sharp declines. Recognizing the signs of a bubble can help investors avoid significant losses and make more prudent investment choices. Market crash is a sudden and severe decline in asset prices, often triggered by panic selling or major economic shocks. While crashes are rare, they can have lasting effects on investor confidence and market stability. Understanding the causes and warning signs of crashes can help investors prepare and respond effectively. Successful investors adapt their strategies to changing market trends. This might involve rebalancing portfolios, shifting to defensive assets, or seeking new opportunities in emerging markets. Flexibility and a willingness to learn are essential traits for navigating the ever-changing investment landscape. Studying past market trends and events can provide valuable lessons for the future. History often repeats itself, and understanding previous cycles, bubbles, and crashes can help investors avoid common mistakes. Continuous learning is a cornerstone of successful investing. Keeping up with market news, economic reports, and global events is essential for understanding trends. Reliable information empowers investors to make timely and informed decisions. Developing a habit of regular research and analysis can set you apart in the investment world. Summary: understanding market trends is vital for successful investing. By recognizing patterns, analyzing data, and staying informed, investors can make better decisions and manage risk more effectively. Remember, the market is always changing, but with the right knowledge and strategies, you can navigate its ups and downs with confidence. Thank you for joining us on this journey to understanding the impact of market trends on investment.